if you would like to take it away, go for it.
Thank you, Gregory. Hey guys. Hey, first of all, thanks so much for having me. For those of you who don't know me, my name is Jeff Kale. I work with Prime Lending. I'm the production manager here in Carson City. I have been in the banking industry for 27 years and in mortgage for 19. And I can't believe I probably have another 15 to 20 to go. But needless to say, I've seen some interesting things over the years. Was around for 9/11 and the crash of 2008. And here we are in 2020 in a COVID environment. So what we're going to do is we're going to go ahead and just go through, I put together some slides and some basic information of what we're doing in this day and age and kind of how things are shaping up in this COVID environment, which I'm sure you're all realizing is pretty fluid at the moment. So let me just click a couple of buttons here and we will get started and we'll go from there. Bear with me in here. All right, guys, working through COVID. So an update here. So basically, March 2020, the country pretty much goes on lockdown. Once lockdown happens, federal government comes out and says, uh-oh, we've got a big problem here because people are staying home from work, not being paid. We're going to have a huge major issue here. So they come up with the CARES Act, which is basically the opportunity for a client to defer payments or go into a forbearance for up to 12 months with their current lender with basically no documentation. They can just kind of walk in and say, hey, I need a forbearance for X number of days or X number of months, and just approve me for that. Well, it was a great idea, obviously, because we had people that were out of work. Nobody knew what was going to happen. But ultimately, that kind of throws the financial markets into turmoil because nobody knows, well, who's going to be making the payment. One of the things we covered in the Lunch and Learn that last week or a new member orientation that I don't think a lot of people were aware of, there's a guideline out there, a rule that basically when they instituted forbearance, you have the servicer that collects the payments from the borrowers, and then they send those payments to the investor. Well, when the forbearance came out, they basically said, well, you have to basically forgive or not accept these payments, but you actually have to continue to pay the investor. And so that threw the markets in total turmoil because they basically said, well, how do we pay the investor if we're not receiving anything from the borrower? So they finally got all that worked out, and the federal government came in and stepped in to keep the mortgage market going, basically doing what they did back in 2008, which is quantitative easing. So they basically stepped in and said, hey, mortgage industry, we're going to support you through the forbearance. We're going to support you through the purchasing of mortgage-backed securities, and we're going to keep this market going. So that was really good because it started to create some stability in the market and basically made sure that everyone knew the world wasn't going to implode. But what it still did is with forbearance and a lot of these programs they had coming out, they said, well, what does this mean? What does this mean for the lender and how do we apply this as rules going forward? So for a good chunk of that time, let's say April to around June, people were trying to figure out what forbearance meant. We knew that a couple of things, they came out with some guidance here. They basically said, well, what is forbearance? Well, forbearance is not a forgiveness of debt. It's basically a postponement of payments or the ability to add those payments to the back of the loan to restructure that so that the client basically doesn't have to come up with those dollars. Originally, when it actually first came out, when they came up with the forbearance, the guidance was you can defer payments for up to, I believe at that time was 6 months, but they were actually going to have the client pay that back. And then we got more government guidance on that. And they said, well, we need to allow that borrower if they don't want to pay the 3 months. So if you defer in April and you got to go till July or August 1st, and now you owe $8,000, we're not going to make that client pay that $8,000. We want to give them the ability, if they don't have that, to restructure their loan and put it on the back of the loan. And that's kind of where some of that guidance came through. All the payments don't have to be paid back in one lump sum. That is one loan option that you can do, but we're seeing a majority of things today. We're seeing clients who were in forbearance have negotiated and restructured their loan with their lender, and they're putting that on the back of their loan. And that seems to be the predominant piece. But we still had some other pieces and questions to that. one of the questions that we typically were having was forbearance going to affect the credit score? So that was a huge concern that we had as lenders. We all remember the short sale days. If you were going through 2008, short sales and deed in lieu of, and all of these things that affected clients' credits for a long period of time. Again, one of our questions was, does this affect the credit for a borrower? So if the borrower requests a 90-day forbearance, is that going to show up as a 90-day late, which would have a dramatic effect on their credit score? And essentially, the federal government came out again with guidance, and Fannie Mae and Freddie Mac and said, no, if you're requesting that forbearance, it is not going to adversely affect your credit. And that was something new that we saw as well. So when we pull credit reports, you would typically see little things that underneath each trade line. So you could have a mortgage loan that maybe showed, that it had been modified. So there'd be little notes and pieces in there. Well, we started seeing forbearance requested. So then the next question that came out for that was basically, well, what does that mean for the borrower? If they've had a forbearance, can they effectively actually get a loan if they're in forbearance? Or what do the terms have to be to have that settled? And basically, what they came out with was, if you have a forbearance and you've requested that forbearance, you have to have either paid your payments current, or you have to have finished your negotiation with your lender. So it's either got to be modified to the back of the loan, or you've got to figure out where you're at and what your terms are going to be. You can't just make partial payments on your loan because it has to be settled. They don't want you in transition while you're doing that. And so, so they came out with that information, and then they basically said, well, as we do that, what if we have a borrower who is basically been done with their forbearance, negotiated with their lender? Is there any other terms that we have to have? And what it would be is, yes, the additional terms to that is you either have to be paid back in full, renegotiated your owed dollars to your lender, whether that's paid in full or whether that's put on the back of the loan. And then you need to have 3 consecutive months worth of payments. They want to see that you've reestablished your credit. They want to see that you have or reestablish your payments, that you're still not in that forbearance piece where you're not able to make your payments. And so again, this is kind of, as you can tell, going through the slides and the timeframes here, this was all an evolving, a learning process, I should say, because we've never seen it before. We've never seen a pandemic before. We've seen terrorist attacks and market economy crash, but we've never seen that pandemic. So everyone's kind of learning on the fly. And now what we're seeing going into August, September is some more clarification in regards to forbearance. And I would just keep in mind that we're going to continue to see that guidance, and that guidance is ever going to evolve. Fannie Mae, Freddie Mac, FHA, VA, they are all going to continue to evolve their forbearance policy. So you're going to want to make sure that you're staying up to date with your lender, or at least your lender is keeping you up to date. Some good news that we saw. Basically, in August, we started to see that forbearance request rate started to drop, and it has continued to drop steadily throughout the whole time. So some recent changes that we saw in regards to forbearance and guideline updates. So typically when you're qualifying a borrower, especially if they have stability in their employment and they have stability in their work history, if you have an hourly employee that basically earns 40 hours a week, let's say $30 an hour, we do the math, they have the history, and that's what shows up on their pay stub. Well, what we ended up seeing happening during COVID was furloughs, or time away where businesses were shut down. And so what's happening is they're taking a look at those companies or those clients that have had a fluctuation in their income, and they're actually taking into consideration that income loss for the year. So why is that important? Well, if I have a borrower that I know makes, as we said, $30 an hour, 40 hours a week, I can do the math pretty easy on what you make per month, and we do your qualification on that. Well, now if we had a 2-month gap because they were in a business that was non-essential, that was shut down for 60 days, they have not earned as much income this year. So what that ends up doing is obviously changing their qualification ratios. So in scenarios where you have borrowers that have tight ratios, let's say, for example, on a bond loan, you can't go over a 45% debt to income on a bond loan. So if we qualified you at 30 hours or $30 an hour, 40 hours a week for a bond loan, and now we have that fluctuation in income and you're not making that, and your debt to income ratio is 44.5%, and we know you can't go over 45, we could have an issue. So that's kind of where you're also seeing, I've heard lots of conversations with real estate agents where things are falling apart at the end, or they're getting into underwriting and the underwriter's coming back and they're saying all of a sudden that the client doesn't qualify income-wise. It's usually one of those questions we're trying to ask up front, especially to the borrowers. Did you or did you not have any furlough time or time off during the shutdown? Because that could eventually basically affect your mortgage qualification. The other little piece that we're seeing too is self-employment. Self-employed borrowers, they always have it the toughest between tax returns, P&Ls, and typically the government had really, Fannie Mae, Freddie Mac, VA, FHA had loosened their guidelines a little bit when it came to self-employment. So we were just getting tax returns. There was a time where you had to provide P&Ls regardless of what time of the year it was, because they wanted to see where you were at for the current tax year. So we may have your 2019 tax return, but it's June of 2020. They want to make sure that cash flow was proceeding on track for what you did the previous year. But that had actually kind of faded away, and then here comes COVID. So with COVID, they basically said, okay, the biggest hit, other than obviously hourly employees or service industry employees, is self-employed borrowers. So they came up with an additional guideline that we standardly have, which is basically a year-to-date P&L for every single self-employed borrower. They want to see what happened during that shutdown. Were you or were you not affected by that? And that, again, can cause you issues depending on that cash flow. So we are seeing now where we would get a P&L and a borrower would have a positive cash flow for the year, because in a normal year, it would go ahead and they would go ahead in a normal year and there wouldn't be any major differences. Well, now we can get a P&L and we're lost for the year. And even though it's September, because they had a 2-month break. So that's a significant piece. The other thing that they're asking for is business statements. So typically for a self-employed borrower, unless you're using business funds for down payment purposes, we never collect business statements. We do now. They want to see that the business is operating back to normal, that the deposits are on track, and that their bump because of COVID is no longer there. So that also creates another layer of potential issue when you're looking at qualification for a borrower. And then another thing that we're seeing is minimum credit score increases. So government programs like VA, FHA, USDA, that we saw some flexibility of minimum credit scores. We're seeing 640 minimum credit scores. So in the past, the VA may go down to, depending on your lender, could go down to 600, or there was even talk of a 580 FHA credit score. That's all gone. 640 minimum credit score. So it's more imperative now that your borrowers figure out where they're at and what program they're doing, because a lot of that flexibility that we had is gone. And those are just a few of the changes that we're seeing. Questions that come up pretty regularly are PPP loans. So payroll protection program is what the government came out with, again, to help small businesses keep people employed. It's not something that necessarily adversely affects your mortgage process if you took a PPP loan, but it does have to be answered, which is pretty easy. It's basically, I was affected by the COVID because of, the government shutdown, business was down a little bit. I needed to keep my employees employed. But the one thing that you can't do is you can't use that PPP loan for income. So that's just another little tweak that's in there. You may have gotten a big PPP loan that bridged the gap as far as your cash flow and being able to keep your employees employed, but it's not something that we can add and say, oh, we're going to use the loan to supplement income that you lost at the time from an income qualification perspective. So PPP loans are relevant in the process, but they're not something that at this point that we're really seeing major issues with. We're seeing more issues with the information that I provided as far as furloughs, time away, self-employment is really where we're seeing a few of those things. A couple of things that we're seeing too, appraisals. We've seen everything from appraisers setting out specific examples of what they want everybody to maintain 6 feet apart, wearing gloves and masks, to appraisers who aren't doing anything. So it's creating an interesting dynamic between appraisers, borrowers, who wants to come in the house, who doesn't want to come in the house, what the rules are for entering the home, when you're showing the home. As you guys know, there's all kinds of crazy things out there that we're seeing, and that basically can delay your appraisal a little bit. The other thing that we're seeing in regards to appraisals is we're in a refi market. So you're seeing turn times for those appraisals take longer. typically would recommend that you guys go back to longer escrows. There was a time where we were doing 60-day escrows or a 45-day escrow because we needed to make sure that we had time to meet those contingencies. And that's kind of the environment that we're in now. If you're using what they call an AMC appraiser or evaluation partners or somebody who is a hub for appraisers and sourcing those out, we're seeing longer turn times for those. And that's where you guys are seeing, 20 to 30 days. And so we want to make sure that as you're writing your contracts, your appraisal contingency dates are actually coinciding with that. The other thing is be aware, it's already difficult enough to get an appraisal in a town. So if you're in Carson City or Douglas, sometimes those turn times are longer. As you start going out to outlying areas, you can see longer turn times. You're going to see more expensive requests for appraisals. And so those are some of the things that we're seeing. Just be prepared too. We've got a kind of a wild market. Things are appraising. I'm seeing appraisals come in a little short on some ends. I'm seeing appraisals come in higher. So do your research on your comps. Make sure that if you have your comps available, leave them for your real estate agent, or leave them for the appraisal. Tell them you've got some comps to give them, and so they can take them into consideration. And so just be aware of that we're all obviously working in a little bit of a different environment. Some of the things that we're seeing that are actually helping is in this environment, you're seeing more clients are kind of coming back to some of the face-to-face meetings, but there's still a big distance between the borrowers and what was normal. So we're seeing a lot more digital access. We're seeing applications online. We're seeing everything via e-sign. And then we actually have an closed program for prime lending. It hasn't been a huge hit because obviously e-sign documents, you guys sign all the time. You can either have somebody who really knows what they're doing on the computer, and then you're going to have somebody who's completely lost. So, usually by the closing process, we're trying to make it as normal as possible. But all of that qualification and all of that information that we're obtaining up front can all be done online. Let's go to the next slide. So ready, willing, and reliable. Some of the challenges that we're seeing in regards to pre-qualification letters and loans that are falling apart. Been having discussions with a lot of real estate agents lately. What you have going on right now, this is just my personal opinion, is you have guidelines that are changing dramatically. And then you have a lot of clients that are going to online lenders. We have a refi boom. So what's happening is you're having lenders are recruiting individuals to take loan applications to what we call a centralized delivery system. They answer the phone, they quote the information to the client, they take the package, and they give it over to somebody in processing, and they kind of wipe their hands and move on from there. We've seen, in my opinion, an influx of that because of the volumes. Lenders want to capture those loans. So they're hiring loan officers who don't necessarily have that knowledge base. So it's very, very important that you guys are aligning yourself with a lender that is going to go through all those fine details, that is going to make sure your client understands what's going on. And then more importantly, if there's something that they're seeing that's a potential red flag or a potential underwriting issue, that they're sharing that with you. I always say, if we know that there's an issue and everybody's on board and it's all been communicated, then usually we can work through that and no one's completely surprised if something comes up down the road. But make sure that you're aligning that. I know you guys have to refer out multiple names, but as I've always said, you can always highly recommend a lender. And there are some good ones. And I'm not going to be selfish and say, send them all to me. I mean, I would be. But the other thing is, I know there's some other good lenders out there. Make sure you're aligning yourself with a really good lender. Yeah, and if you guys have any questions, I'm trying to make sure I leave enough room for some Q&A here. If you guys have any questions, feel free to call. Or call your lender that you know. Communication is the biggest piece here. I always say assumptions in mortgage are going to get you killed. You can't just assume that everything's going to be okay. And if it takes a 30-second phone call just to say, hey, I've got this scenario, or hey, is this going to be an issue, or what do you think about that? That can go a long way in your mortgage process because it's so foundational. The other thing I say is it's not like Jenga. Once we build it, we don't really want to shuffle those things around on the bottom because it really can cause a lot of havoc. But if we know about it ahead of time, we can really address those potential issues that you have. And that's about it for my presentation. So I'm sure there's going to be some questions, and I'm going to wait patiently here because I believe Gregory is gathering those questions and should have them over.
All right. Hey, Jeff. Again, thank you.